Hey folks, welcome to a product review at Finominal. Today we're going to look at one of the largest dividend-focused ETFs globally, which is Vanguard's Dividend Appreciation Fund. Now, the ETF trades under the ticker VIG, manages close to $80 billion, and is quite cheap at 6 basis points. Having said that, the interesting part is that the ETF is not focused on stocks that pay high dividend yields, but rather on companies that have been increasing dividends consistently. So let's kick off with the performance benchmark analysis. And we're going to use our alpha analyzer tool for that. Now, what we do see is that the suggested benchmark is actually the MSCI US Minimum Volatility Index. And we can see also the comparison of the ETF, i.e. VIG, compared to the US Minimum Index or the S&P 500, and we see a few metrics in terms of tracking error, correlation, R-squared. Now, overall, you could pick either benchmark, they're quite similar. Having said that, what we do see from a performance perspective since the inception in 2012, that effectively the performance between VIG and S&P 500 and the Minimum Index were relatively comparable until 2020. And post-COVID, effectively the S&P 500 outperformed both significantly thereafter. Now, if you want to dig into that further, one thing we can do is we can switch the benchmark to the US Minimum Index, and we can look at a holdings-based factor exposure analysis. Now, what this simply shows us is the fundamental metrics of the US Minimum Index versus VIG. And the ones that I'm using to focus on is dividend yield. So dividend yield, we see, for example, that VIG has a dividend yield of 1.9% compared to the Minimum Index of 2.1%, so quite comparable. We actually also do see that from a volatility perspective, the US Minimum Index is slightly lower volatile, but not by a whole margin. And we can also see on other metrics that overall the VIG is quite comparable to the Minimum Index. We can kind of see the average for the Minimum Index, which is the dashed line. And we can see on valuation metrics, on kind of like these other metrics, overall there's a lot of overlap. Now, if you want to go back to using the S&P 500 just as a comparison, we can do that and then look at the factor exposures more from a statistical perspective. So let's go to a return-based factor exposure analysis. So instead of looking at the holdings, we're going to look at the returns. And what we can see here is that VIG, compared to the S&P 500, historically had consistent exposure to the low volatility factor, which also explains why you could argue that the Minimum Index would be the right benchmark. We also see consistent positive exposure to the quality factor, slightly positive exposure to the size factor, i.e. small caps, and consistently negative exposure to value and momentum. And that's kind of expected because if you think about the kind of companies they're buying, these are companies that have been consistently raising their dividends, which doesn't tend to be stocks that are high in momentum or particularly cheap. These tend to be companies that rank high in quality or in low volatility, simply reflecting their business model. For example, utility companies or real estate stocks. Now, the other part that's kind of worth interesting exploring is how does VIG compare to a minimal product and the S&P? And for that, we're going to go to asset compare and effectively try to find out what's special about VIG. Is there anything unique about this fund? Because it's not a dividend yield, and we're going to take USMB, which is an iShare product, as a proxy for the Minimum Index, and we're also going to add the S&P 500, but we're going to use SPY for this. Now, the first thing is we already looked at performance, so we can see again the S&P 500 how it has outperformed most recently the Minimum product as well as VIG, the Dividend Appreciation Fund. But let's dig into the risk-adjusted returns. And what we see over here is the Sharpe ratio of VIG was 0.93 over the last 12 years. Having said that, the Sharpe ratio of the Minimum product, which is the USAB, was 0.88, and S&P 500 is 0.86. Now, that's not that great because we already know the Dividend Appreciation Fund, it doesn't feature a high dividend yield. For that, I can go to the minimal product. And it also doesn't feature a higher Sharpe ratio. And we can just visualize that on a simple risk versus return chart. And so effectively, you can see the S&P 500 that has the highest amount of volatility, but also has achieved the highest return over the last 12 years. We can see that low vol product, USMV, which has a much lower volatility, but also low return. And we can see the dividend appreciation index fund in between, VIG. Now, this chart, from my perspective, kind of wraps up this product review in the sense that this is a product that isn't particularly useful for asset allocation. Now, if you're looking for high yield, there are high yield products like dividend yielding strategies or from fixed income, but this is not what VIG offers. The VIG dividend yield is quite low and doesn't offer high risk-adjusted returns. There's actually nothing unique from our perspective that we can showcase. And that's not great. So from our perspective, if you do want to have a high yielding strategy, there's plenty of other options. If you do want to have a certain focus in terms of quality or low volatility, go for smart beta ETFs. But selecting stocks on dividend appreciation just doesn't seem to be sensible stock selection criteria. That wraps it up. Hope this was useful. Have a nice day.